This is David. He's 66, just retired. He has a £100,000 pension. He wants to take £20,000 out to renovate his kitchen. He's careful, he's sensible. He's heard the rule. 25% of your pension is tax-free. So he thinks, I'll be fine. But David is about to lose around £2,996 in tax, even while staying fully within the rules as they are currently written, because nobody explained one simple thing: how HMRC actually treats that money. Hello, I'm Angie and this is UK Money Wisdom. In this video, I'm going to show you the 3 ways pensions are taken, why they create very different tax outcomes, how £10,000, £20,000 and £30,000 withdrawals behave, why this is getting worse over time, and how to avoid handing over money unnecessarily. Stay with me because this builds step by step. There are really only 3 ways to take money from a defined contribution pension. Look at this table and at the main features of the 3 main withdrawal methods. You see, with an annuity, you have a steady income. Drawdown, on the other hand, gives you controlled access, and a lump sum is where you take chunks directly. Now here's the key point. They don't just feel different, they are taxed differently. Here's the rule people only half hear. Most people are told 25% is tax-free, and that's true, but here is the missing half. The other 75% is treated as income when taken. You see, the tax system doesn't see pension money, it sees income landing in a tax year. Now, this is where things have quietly changed. Most people think of the personal allowance as a comfortable buffer, but over time, that buffer has been shrinking. We see that personal allowance has been frozen at £12,570, whilst our state pension has been rising under the triple lock. What this means over time is more of your allowance is already used before you touch your pension. For the 2026-27 tax year, state pension is projected to be roughly £12,548. Since the allowance is £12,570, you will see that leaves only around £22 of personal allowance remaining, though this will vary depending on your exact income. And £22, that's a couple of pizzas. After that, the taxman is rummaging in your pocket. No one is saying you have no allowance left, but what is true is many may have far less than they expect. And that is what turns a normal withdrawal into a tax surprise or shock. In practice, your first withdrawal may be taxed using an emergency code and then corrected later. So the tax you see at first may not be the final amount. This is, as I say, often corrected automatically, or you can reclaim it from HMRC. Okay, let's go back to David. He's taken £20,000 as a lump sum. So in this example, £5,000 comes out completely tax-free, £15,000 is treated as income. And this is the key step. That £15,000 does not sit on its own. It's added to David's other income. This is what HMRC sees. David's total income has risen to £27,548. Now apply the personal allowance. The amount above allowance is £14,978. And that is taxable. Your tax calculation at 20%, you'll see, is £2,995.60, nearly £3,000 in tax. And once his state pension has used up all of his allowance, that £15,000, you see, is almost fully taxable. That is where the tax comes from, not from the £20,000, but how it lands in the tax year. Now let's widen this out, because this isn't just about £20,000. Look at the different withdrawals in this table. You'll see in this example 3 different withdrawal amounts: £10,000, £20,000 and £30,000. And also in this example, the £22 is all the tax-free allowance remaining after the state pension. Once that is used, every additional pound is taxable. Look at the £10,000 withdrawal. And working through the example, you'll see tax-free £2,500, taxable £7,500, less £22 allowance. That leaves £7,478 of taxable income at 20%, nearly £1,500 in tax. And as we saw in the 20,000 withdrawal, I'll show it again above. There's the £2,995.60, nearly £3,000 in tax. And with a £30,000 withdrawal, going through this example, you'll see how it builds up to £22,478 of taxable income at 20%, which will cost £4,500 in tax. So what has changed? Compare this to 2025-26. Before, we had a £597 buffer, but now that buffer is only £22. And once it's gone, every pound is taxed. Notice what's happening. You don't double the withdrawal and get double the tax effect. You increase how much taxable income lands in 1 year. It's not the withdrawal alone, it's the interaction with your allowance. You see, drawdown and lump sum are not just different names, they are different methods with different tax behaviour. In the above table, we see how a lump sum UFPLS uncrystallised funds pension lump sum works. Every time you take money, you have 25% tax-free, but 75% taxed straight away. You cannot separate the tax-free and taxable parts. Now let's change one thing. Instead of taking a lump sum, David moves his pension into drawdown. He takes £20,000, but this time from his tax-free entitlement. Let me explain this carefully. Because he is drawing from the tax-free portion, HMRC sees £0 taxable income, as long as the withdrawal is taken entirely from the available tax-free portion. And here's the direct comparison. You have the same £20,000 in his bank, but completely different tax outcome. That is not a loophole. That is simply using the system differently under the allowed rules. Now let's look at the third method. Annuities are often misunderstood. They are not about maximising flexibility. They are about removing uncertainty. In this table, you'll see that the advantage here is timing. Instead of one large taxable event, income is spread over many years. And spreading income usually keeps you in lower tax bands. There is one more area to be aware of, and this is important, but it is still evolving. Historically, most pension funds have sat outside your estate for inheritance tax purposes. This has made pensions a very efficient way to pass money on. But we need to look at what is being discussed at the moment. The government has proposed changes from April 2027. These could mean that some pension death benefits are brought into the inheritance tax system. But this is crucial to understand. These changes are not yet fully legislated in final form. The exact rules, scope, and timing may still change. But what this could mean, if implemented as proposed, is that pensions may become less sheltered from inheritance tax than before. In some situations, part of a pension could be subject to up to 40% inheritance tax. So what will determine the outcome? Well, final legislation, of course, passed by Parliament, the specific pension scheme rules, your age at death and how benefits are taxed, and your overall estate position and allowances. Pension decisions are no longer just about income in retirement. They may also affect what you pass on to your family. That is not something to panic about, but it is something to stay informed on. If you are planning your pension strategy, keep this area under review and avoid making irreversible decisions based on proposals that are not yet final. I will keep this channel updated as soon as any confirmed legislation is published, so you can make decisions based on facts, not headlines. Let's step back and look at the mechanism. We see in step 1, state pension uses allowance. Step 2, withdrawal adds income. Step 3, income combines. And 4, tax increases. The system isn't broken. It's doing exactly what it's designed to do, but it's very rarely explained to us this way. And here's how we deal with it. These are some practical actions that you can take, which I show in the table above. You can spread your withdrawals, use multiple tax years, use your tax-free portion first, avoid triggering income, that is, control timing, and check your total income, which will help avoid surprises. The goal is not to stop paying tax completely, it's to stop paying unnecessary tax. If you take one thing from this, 25% tax-free is only part of the story. 75% drives the tax, and timing controls the outcome. State pension, same withdrawal, different outcomes, remember. If this helped, do explore my other videos and do please subscribe and like in order to ensure that you receive my next videos. And if you know of someone who could use this video, do please share with them. I'd really like to hear from you in the comments. So if there is anything that I can give you more help on, add your comment. And which approach feels safer to you? Drawdown, lump sum or annuity? Let me know below. Or let me know if you're confused and you need a more in-depth explanation. Be happy to do that too. Finally, my disclaimer, as always, to ensure you understand that this is general information only and not personal financial advice. It is based on current UK tax and pension rules and public guidance for the 25-26 tax year, with forward-looking illustrations using proposed 2026-27 state pension rules. Because you see, individual circumstances do vary and rules do change. I'm Angie, and this is UK Money Wisdom. I'll see you all again soon, and I look forward to chatting with you in the comments below. Bye for now.